So about a year ago, I put out a video on covered call ETFs and how they might be costing you money over the long term. Not how they might be, how they are costing you money over the long term. And this was quite possibly one of my most controversial videos I've put out. There was a rebuttal video made, and in the end, there was a ton of negative feedback directed towards me in both the comments of the video, emails, on our website, wherever it may be, about how I put these funds in a bad spotlight and how I didn't truly explain most of the benefits of these funds. Now, one of the main benefits that I supposedly did not speak on was the downside protection that these funds will provide in a bear market. So I figured we've been in a year-long bear market, one of the roughest ones we've witnessed since the financial crisis. So I figured it would be a great time to go back to that video, go over the ETFs that I speak about in that video, and see how they stack up compared to the non-covered call variants, to see how well they've protected people to the downside, if they have at all. And as a bonus in this video, the last two ETFs I'm going to talk about, these funds weren't around when I released the first covered call video. I wish they were, because I would have been able to speak on them and quite possibly save some people who have a yield at all cost mentality from investing in a few of them. So you're going to want to stick around till the end of the video when I talk about these two covered call ETFs that have gotten absolutely wrecked so far in 2022. With that said, let's turn to the screen and go over some very popular covered call ETFs and how they performed in 2022 relative to their non-covered call variants. So before we start the video, remember, smash that like button, head down below, comment, let me know if you own any covered call ETFs. How are they performing this year? Let me know if you like them, if you don't like them. And also remember to subscribe to the channel. More likes, more subscribes, more comments means more free content. Now, one absolutely key disclaimer I want to speak about before I start this video as well is I am not trying to discourage in any way people buying these for the income. I understand everybody has different strategies. You may want to buy these because they provide a stronger passive income stream. If that is the case, go right ahead. I am not trying to stop you. The reason for making this video was primarily to highlight the key misconception a lot of people have about these funds, and that is the fact that they do provide downside protection in a bear market, typically because of the structure of the covered calls. They tend to provide a small amount of downside protection, but as we go through many of these funds, you're going to see that they have provided virtually no downside protection during the bear market. So this video in no way is trying to discourage you if you are an income investor. It is just to highlight some possible errors in investor judgment when it comes to downside protection, especially in the final two ETFs I talk about, which you can probably see in the top bar there is the cryptocurrency covered call ETFs. So the first ETF I want to talk about, which is one I highlighted in the original video, it is the Canadian Equal Weight Banks ETF versus the covered call Canadian Banks ETF. If we look to both of the returns over the last year, banks have been on a decent drawdown. We look to the BMO Equal Weights Bank ETF in terms of just price. This is just the change in the underlying price of the ETF. We can see that's down around 13.4%, while the BMO Covered Call Banks ETF is around 16.5%. So in terms of overall price, the non-covered call version, even though we're in a year-long drawdown, has outperformed. However, this is not the way you want to look at these ETFs. Obviously, the covered call ETFs are set up to pay a high distribution, so we have to look to total returns and we have to look to reinvested dividends, but really it doesn't change the overall returns over this financial drawdown over the last year. In fact, when we look to the returns, if you had reinvested the dividends, total returns, we can see that ZEB, the non-covered call version, is still outperforming ZWB, and there was virtually no situation in the past year where the covered call version gave you any sort of downside protection in terms of the drop in Canadian banks. This is a relatively small ETF. It only contains Canada's 6 banks. So to be honest, if there was one that I would actually expect to provide a little bit of downside protection, it would have been this one, but it just really hasn't. So you've not only underperformed in the bear market with this ETF. If we span these returns out to 3 years and we go to annualized returns, we can see that the non-covered call has returned about 8.55% annually, and the covered call version around 5.2%. So that is quite a drastic outperformance. And if we span it out to a 5-year, it gets even worse. We're looking at 6.32 annualized returns versus 4.22%. And if we go to 10 years, it gets even larger. You're giving up around 2% annualized over the last 10 years, which, if we look to the growth of $10,000, this is, around $5,000 based on 10K invested. If you have 100,000 in these banks, you're looking at around $50,000 in lost total returns. So next up, let's look at the BMO high dividend covered call ETF versus just the BMO Canadian dividend ETF. So these both contain relatively the same holdings. As we can see here, it's pretty much a blue chip Canadian dividend covered call ETF. We can see Canadian National Rail, RBC, TD Bank, Manulife Financial, Enbridge, Canadian Imperial Bank of Commerce. And if we look to the non-covered call version, ZDV, we can see that although the holdings are not identical, this is a fund that contains a ton of overlap. Again, Canadian National Rail, RBC, CNRL, TD Bank, Enbridge, BCE, Bank of Nova Scotia. So this is going to be a fund that aims to invest in some of the best Canadian dividend stocks. Now, the one thing about this is these types of Canadian stocks have actually not had that much of a drawdown in 2022. The TSX is not down that much, and especially for its energy exposure, which this fund does have, if you were exposed to energy, you probably didn't even do that bad. And as we can see, this fund, if you had reinvested the dividends, is actually only down 2.44% on the year. If we look to price-wise without investing the dividends, we can see that the fund is down around 5.28%, while the covered call version is down around 9.29%. So this is one that has, again, provided little to no downside protection. You would figure in a 5.2% drawdown over the course of the year that this covered call ETF might be able to carve out overall returns that were higher than that, but ultimately this has not been the case, and there is virtually no situation over the last year where this would ever have been the case. And again, if we span this fund out to long-term returns, we can see that the non-covered call version has outperformed by a significant margin. If we go to annualized returns, we can see that the non-covered call version has almost posted double the annualized returns over the last 3 years. And if we span it out longer than that, we can see that, again, it sits around just under 6% annualized, whereas the covered call version is around 3.3. This covered call ETF, in terms of overall returns, even if you're reinvesting the dividends, is pretty much barely keeping up with inflation over the last 5 years. It has not been the best performing fund out there. And if we go to since its inception, which is in early 2017, we can see it's put out about 4% annualized returns, where the non-covered call version has returned about 6.11%. Overall, price action-wise, I know these funds are meant to provide income to investors, so this might not be the best way to look at it, but we can see that since its inception, this fund has lost around 15%, while the non-covered call version has gained around 9.49. This kind of shows you the impacts of compounding and dividend reinvestment, because once we reinvest the dividends, returns jump to around 42% and 26% respectively. But overall, this is another fund that has not only lagged over the long term, but really hasn't provided much benefit in the short term either during the bear market in terms of overall returns. Yes, it has provided more income, but in terms of downside protection, virtually none. Actually, you would have been better off buying the non-covered call version. So the last fund I want to go over, and in hindsight, it's probably not the best fund. I actually wish I hadn't have included it in the original video just because the holdings are so much different. I just couldn't really find a non-covered call utility ETF that was similar to the BMO covered call one, so I did use their equal weight utilities just because I felt that investors might be choosing between one of the two of these. But the fact of the matter is, the equal weight utilities has a ton of exposure to renewable energy, whereas the covered call ETF does not. So if we look to the overall holdings of the equal weight utilities ETF, we can see that Northland Power, TransAlta Renewables, Algonquin Power, Brookfield Renewables, Interjex Renewables. There's a lot of renewable energy exposure in this portfolio, which has taken quite a thumping in 2022 and 2021, whereas ZWU, the covered call version, does not contain a lot of this, at least not as heavy of a weighting. We can see that it also includes telecoms and pipelines, midstream utility companies, and telecommunications. It has very, very little renewable energy exposure. As we can see, like Northland Power is the top renewable holding in the portfolio with about 3.36%. Overall, this wasn't a very good comparison, but I'm going to include it in the video just because I talked about it then. I'm going to talk about it now. And this is one situation where you would have outperformed with the covered call version. We can see over the last year, if you had reinvested the dividends, you're down around 5.23%, whereas the equal weight utilities ETF, you're down around 9.4%. Now, this was not always the case throughout the year. We can see that, up until September-ish, the equal weight utilities ETF was outperforming by quite a wide margin. It was actually up 8.3% on the year. However, we started getting more aggressive rate hikes, and as a result, utilities started selling off, particularly a lot of renewable options, a lot of ones that are, in poorer debt positions than, say, a regulated utility like Fortis or, a pipeline or a telecom company. And that is why the covered call utilities ETF was able to perform so well during this period. So overall, price-wise, they're down about the same. But again, that doesn't really matter. This one, I'm not going to speak too long on this one because, again, I kind of regret putting it in the original video. It's not really a fair enough comparison of these two funds. But for somebody who's looking at BMO products, they want a utilities ETF, they are probably going to look at the two of these and, consider choosing one. And in that regard, I still do like the equal weight utilities ETF a lot more. Again, the covered call ETF has provided a little bit of a downside cushion in this bear market, but not really enough to justify the overall returns, especially when we span it out long term. I mean, you can see this fund, the covered call utilities ETF, if you had reinvested the dividends, it's only returned 1.81% over the last 5 years. If we annualize this is only around 0.6% annually. We can see that the equal weight utilities, primarily because of its exposure to renewable energy, is sitting at just shy of 7%. And if we go to 5-year returns, it gets even worse. We're talking a 5+% annualized return difference, and when we span it out to 10 years, it gets it's nearly double the equal weight utilities ETF. So overall, I'm still not a huge fan of ZWU. The only difference being that I don't really feel it was a valid comparison for those who are considering covered call versus non-covered call. They have way too much variance in their overall holdings. But the next ETFs I want to get to, and quite possibly the most drastic in terms of downside protection and how there has virtually been none, are the crypto ETFs that Purpose Investments put out, just due to the sheer popularity of covered call ETFs over the last few years. So looking back on it now, I really wish I would have produced a video when these ETFs came out. I had so many questions about these funds, particularly because crypto at the time was at its height in terms of popularity, and a lot of our audience wanted nothing to do with cryptocurrency. But as soon as these ETFs came out, ones that paid a yield, certainly to our passive income audience and those who want dividends, these became very popular options. And again, one of the primary reasons a lot of investors wanted to own them was because of the fact that they were given the impression that they would provide some sort of downside protection. If crypto crashed, don't worry, they have the passive income. The price should be sheltered a bit because of its covered call strategy. And this wasn't just an assumption made by investors. This was what they were told. If we go to purposes page on the Bitcoin covered call ETF, we can see that this strategy can limit the downside during bear markets and provide a source of income when prices are flat. Furthermore, it can elevate returns in markets with slight price appreciation, but will underperform once prices reach a high enough limit for price participation, which is pretty much how covered calls work. You might have to end up selling your asset for less than it's worth. But the situation here is primarily the downside during bear markets. These funds have provided absolutely no downside during this bear market. As we can see here, the non-hedged and the hedged Bitcoin ETF have lost 63%, around 64% on the year, whereas Bitcoin has lost around 65. So overall, these funds, have provided around a 2% shelter over the last year, while Bitcoin has collapsed. If we go out and span them out to a one year return, we can see that it's virtually the same. The Purpose Bitcoin ETF has lost around 67.4%, while the Bitcoin price has dropped around 67%. So for those who were told that this strategy can limit the downside during bear markets, there has been little to no downside protection, and a lot of people, I personally know a lot of people who would have never touched cryptocurrency otherwise until these funds came out. They ended up buying them because not only did it provide a yield, but it also provided, not a guarantee, but at least the idea that if Bitcoin were to crash, that these ETFs would provide a little bit of a buffer. You'd be better off owning these over just owning the coin, and that just simply hasn't been the case. Now, if we go to the Ethereum ETF, we can see that it's just as bad. If we look to ETHY, which is the Ether Yield ETF, we can see it's lost 71% since its inception, whereas the price of Ethereum has fallen around 73.7%. So yes, you've collected a yield. You have also watched around 70% of your investment evaporate. And I do understand that holding these will give you that yield, which kind of makes it better than holding the coin itself, where you don't really benefit at all. But I felt a lot of investors were misled with these ETFs. High volatility. The fund talked about high volatility and the fact that the higher the volatility, the juicier the premiums are with the call options, which this is true, but ultimately that downside protection that a lot of people thought was there. Again, these are the people that, never really had any interest in crypto until these massive yielding ETFs came out, and all of a sudden there's a passive income stream, so, it might be worth investigating. There was a lot of people who did not expect to be 70+% in the hole after a calendar year of owning these funds. So again, I wish they had come out when I had that other covered call video, and I wish with the feedback and the inquiries I was getting from these, I wish I had made a video a year ago, and it possibly would have saved some people from buying these, but who knows, it might have not. Overall, it's put a lot of investors, primarily those who focus on income and who chase yield at all costs, in a very, very tough position right now. So on the bright side, there has been a few US listed covered call ETFs that have provided a bit of a buffer in terms of downside. If we look to XYLD, which is the S&P 500 covered call ETF, it has outperformed SPY by around 7%, pretty close to 7%. So if you were looking to invest in a covered call ETF that tracks the S&P 500 and you wanted that reduced volatility, this has provided it over the course of the last year, especially with the large drawdown in the S&P. Obviously, over the last 3 and 5 years, it has underperformed by a massive margin. When we go to annualized returns, we're talking, 7% versus 1.2. It gets even worse when we go out to 5 years. We're talking 9 versus 3 pretty much. And over a 10-year period, we're talking not quite double, but 11% annualized versus around 6.5. But one of the covered call funds that has actually done very, very well in 2022, and it's probably because of the crazy amount of volatility, is the NASDAQ QYLD. So QYLD, obviously the returns are not good by any means, even if you had reinvested the dividends, but the NASDAQ is down nearly 35% on the year. Invesco's QQQ ETF is down 35% over the last 1 year. So there's been a pretty big cushion, nearly a 15% cushion when we look to the overall volatility of QYLD during this time. And you also do gain the benefit of that passive income stream. So it hasn't all been negative for these covered call ETFs. But again, I do have to highlight, once we span these returns out over the long term, we can see that QYLD actually has negative annualized returns over the last 3 years. And when we go to 5 years, we're looking at 2.48% versus nearly 11.5% with QQQ. And this is with the NASDAQ taking a 35% haircut. These annualized returns are still that drastic of a difference. If we go out to a 10-year period, it gets even worse. We're looking at 5.4% annualized versus 14%. If we look to, $10,000 invested, we're talking $16,000 versus, nearly 33. I mean, if you have a six-figure portfolio and you're buying QQQ as an index fund with, $100,000, you're talking about $160-some thousand in difference over that long term. So yes, it has provided quite a nice buffer over the last 1 year period, but over the long term, I would still expect QYLD to underperform QQQ in terms of total returns. Again, this video is not to discourage those who want to buy these funds for a passive income stream. This was more so to highlight the downside protection and how the vast majority of these ETFs have not provided that, at least the ones I went over in this video. I would love to see some that have performed quite well during this drawdown, and if you do know one, drop it in the comments like I said. So that's it for the video. Really hope you like it. Overall, my opinion has not changed on these funds. I view them as excellent options for those who are maybe in retirement looking to collect a passive income stream. They're willing to sacrifice total returns to get that higher income, typically paid on a monthly basis. But overall, we've been through a year-long bear market right now, and these funds, besides QYLD and maybe some other covered call ETFs I haven't talked about, to be honest, there have been so many of them in the last few years due to the upwards tick in popularity of them. I can't speak about them all, but the ones that I went over in this video, as you can see, besides QYLD, there really hasn't been any notable downside protection in owning these ETFs. I probably got 100 different replies on that video, replies, emails, comments from people saying, hey, we're in a bull market right now. You just wait until we hit a bear market. These covered call ETFs are going to outperform. They're going to be worth the missed returns in the past and in the future because they're going to save your butt in a bear market. As we can see with the crypto ETFs, they have absolutely provided no downside protection. Those who would have never touched cryptocurrency otherwise might have bought these now that they provided a dividend yield, and now they're sitting on negative returns of 70-some% when the underlying cryptocurrency is down just as much. And as I showed you directly on Purpose's website, they do speak about that potential downside protection. There has been absolutely none. And there has been none in the other funds that I showed from a year ago. We can see that the banking ETF is outperforming the covered call ETF despite banks being down, 15+% on the year. The utility ETF is underperforming the covered call utility ETF, but that is primarily due to a significant drawdown in renewable energy. This is quite possibly a bad comparison. Looking back on it a year down the line, I do regret that I included those two in the video, but I felt I would touch base on them anyways. They are two very different funds. And finally, the high dividend covered call and the high dividend ETF. We can see that despite the drawdown, the covered call ETF is still underperforming the non-covered call version. So the downside protection and the potential in a bear market for these funds to perform quite well just hasn't existed. So again, smash that like button if you like the video, subscribe to the channel, comment down below. What do you think about covered call ETFs? And I'll see you next time.